Hello everybody, welcome back for another video. Hope you're all well and that you're all having a great day. A number of researchers at Yale believe they have identified the best times to buy cryptocurrency. A pair of economists from Yale University have outlined a basic strategy for identifying the best buying opportunities for cryptocurrencies by studying the past performance of three of the most well-known digital assets. The two have identified a couple of methods to predict price movements. The volatility of cryptocurrency markets makes choosing an entry point to the average digital investor buyer tough. The most popular digital currency, Bitcoin, has been known to swing wildly over just a few hours. As this was written, the price of Bitcoin is down over 12% over the last 24 hours. The announcement of the US SEC to postpone a decision on a highly anticipated Bitcoin ETF seems largely responsible for the latest dip. That said, two Yale economists believe they have identified two factors that can provide useful indications as to how the price will move in a paper titled Risks and Returns of Cryptocurrency. Economics professor Ale Tvinsky and economics PhD candidate Yukon Liu explore historical price patterns in an effort to identify factors that can determine how the price will move over a short period of time. The pair studied movements during the period of 2011 to 2018 for Bitcoin, 2015 to 2018 for Ethereum, and 2012 to 2018 for XRP. They were able to identify two factors that gave indication as to how the price would move. One was the momentum effect, and the other was the investor attention effect. The first factor identified by Liu and Svinsky is momentum. In the report, the economists noted that if the price of Bitcoin increased rapidly during a single week, it would likely continue to increase during the following week. This was said by Svinsky to CNBC. They said, and I quote, "Momentum is actually something simple. It goes up, they continue to go up on average, and if things go down, they continue to go down." End quote. That is actually quite simple. The report goes on to state that the most risk-free strategy for trading digital assets using the momentum effect was to buy said currency following a week in which the price had experienced a sharp uptrend upward, around 20%, and then to sell another week later. That's actually quite interesting. The second factor highlighted in the report is the investor attention effect. This simply means that the amount of interest around cryptocurrencies at any given time could be used to predict price movements. In the report, they state that the Google Trends and Twitter posts gave good indications of investor attention. This was actually something quite interesting as well. We had a couple of days ago the news that the Google Trends for the name Bitcoin have started to slowly creep back up. A couple of weeks before, this had to be 4 weeks ago by the time we'll be making this video. It was actually quite interesting because Ethereum, the word Ripple, and Tron were all outpacing the Google searches on Google, as opposed to people searching for Bitcoin. So people were more interested in looking for altcoins than they were for actual Bitcoin. They said, and I quote, "A one standard deviation increase in the Twitter post count for the word Bitcoin yields a 2.50% increase in the 1 week ahead Bitcoin returns," end quote. Meanwhile, the opposite also holds true. For example, rises in the number of searches for phrases such as Bitcoin hack were indicative of lower prices. However, during that period, the pair are keen to stress that they are not giving advice to investors. They also conclude that their metrics are neither hard nor fast rules. Svinsky told CNBC of the risks posed to crypto traders even when following an academically researched strategy. They said, all things can happen. Maybe the statistical patterns that we find are going to completely change. Maybe tomorrow Bitcoin is going to be prohibited by regulators. Maybe it's going to be completely hacked. There are many things one would take into account, end quote. It is quite interesting the fact that we have now research papers that are being done on this. I saw this, thought it was quite interesting. Everyone has their own idea of why the market moves the way that it does, and the fact that this was researched by people in Yale was quite interesting as well. If you want, I'm actually going to try my hardest, I know I always forget these things, to put this in the description below. If you click on this right here, this leads you to this, which I will leave a link to. And apparently it says You may purchase this paper online in PDF form for $5, but apparently you can get it for free if you are a subscriber. I assume you can subscribe somewhere around here. If you are a corporate associate of NBER, a journalist, an employee of the U.S. federal government with a .gov domain name, or a resident of nearly any developing country or transition economy. So if you're interested in reading what the people from Yale had to say about when is the best time to be able to buy into the cryptocurrency market, you can definitely do so. And I will, like I said, try my hardest to remember to put it in the description below. If not, the words are up here. I know I forget all the time. I do apologize. I'm scatterbrained. Hope you guys enjoyed. Let me know if you got something from this, if you found it interesting, because everyone, like I said, has their own ideas as to when the best time is to buy. A lot of people buy in whenever they want. A lot of people like to buy if the price moves down even by 1%. They see this as a good indication that it's time for them to buy, as they assume that that 1% drop won't last for much longer and that they'll simply be able to make a profit because the market will eventually at some point go back up. Once again, I hope you guys enjoyed. Hope you guys are having a great day, morning, afternoon, and or evening. Thank you once again for watching and or listening, and I will talk to you all soon. See you.